So we're right in the middle of a pretty exciting earnings season, and there's been a theme this earnings season of something that I think's been really important, especially with what we've been working on at Ticker Trends and the Social Arbitrage Fund, and something that's really impacted almost daily decision making about how to approach earnings trades or opportunities in different businesses. And there's also been a lot of discussion from other traders or analysts that I've noticed as well that I felt I could have some interesting feedback on, as to how to look at certain things in the market, when trying to identify or even gauge potential in different earnings trades. So the thing I want to talk about is consensus. I think consensus is actually a really interesting, and quite honestly exciting portion of markets, that I've come to approach more and more, especially as we've grown Ticker Trends. Um, and the reason being is because you have all these factors that go against each other. You have buy side firms which think that sell side firms are like the ultimate saturation of information. Ultimately, the sell side firms are the ones that's generating consensus, yet the buy side firms are the ones that are actually kind of moving the markets and either like buying or selling things on an earnings release. So there's always some level of dislocation between what sell side firms put out and what buy side firms are actually expecting. But what I think is a really crucial thing to understand when trading earnings, and also just understanding consensus in general, is that ultimately the true consensus is not what public revenue or EPS estimates there are from sell side firms. Those are numbers that you have a group of analysts at a bank that are paid to model in Excel these values and create some form of estimate of what they think the number is going to be. But truly, what moves the market is where the buy side firms think numbers should be. And so ultimately, what actually matters is what the buy side firms look at and not necessarily the numbers that the sell side firms look out or put out. And so what's been happening more and more over time is previously, I'd say that this is more of a gradual process, not so much just one stop at a time. But what's been happening more and more over time is that maybe a long time ago, sell side firms were the most accurate source for an idea of consensus. So if I'm a buy side firm and I'm trying to gauge my thesis or an opportunity on a certain company, potentially previously my best source of information to gauge that consensus would have been looking at the sell side firm numbers. And so then when the numbers actually come out from the company, what I would use to gauge if that company was successful or not would be the sell side firm's numbers. And so that's why at times still now, but more so in the past as well, sell side firm estimate numbers were really important. Now, what's been happening more recently, and one of the trends in alternative data and financial markets in general, is that there's a dislocation on the buy side of not necessarily caring about or weighting sell side firm estimates in the same way that they have in the past. And so that's why you'll see all these dislocations. And I see it constantly on Twitter, or throughout retail investors, or to be honest, even maybe some buy side firms, where they say like, oh, this company had a big beat in this number. Why didn't the company go up in price or something like that? And the reality is because I think this idea of like beat is kind of becoming a thing of the past in terms of a beat relative to sell side firms' numbers. And what buy side is actually looking at now is much more complex than just those sell side firm numbers. So I actually think that maybe sell side estimates are like a starting point. And then you have a lot of things layered on top of that, such as, just as an example, third party data tracking for different KPIs, which in a way becomes consensus. Because what's been happening is with the proliferation of alternative data to discretionary analysts and buy side firms. What they're looking at more and more as a real consensus number is when they pay a subscription to Yipit or mScience, they're tracking the performance of these different KPIs. And it's gotten to the point where there is such a broad range of buy side or sell side firms, there's such a broad range of buy side firms that are looking at Yipit and mScience that tracking and that data actually becomes the consensus, to where a firm is positioning for a certain release of that number in a way that's similar to the data that they're tracking. And if the company really misses on that number or expectation, or if the data is revising up significantly interquarter, then the real expectations of buy side will be completely disremoved from whatever sell side firm estimates are being put out. So I think there's been like this interesting dislocation in the market between these public estimates and what buy side actually expects. And I think that this dislocation will only get bigger and bigger over time, especially because at least what I've seen is there's lagging trend in terms of sell side adoption of alternative data or this very advanced modeling that third party trackers provide. So people who estimate and track different public company KPIs, a lot of sell side firms don't have access to that data or that technology, especially because it costs so much. And so whenever it comes to who can access that information, it would be buy side funds because they can make more money and they have a larger research budget. And then the sell side firms, which are putting out the public research, have a much more limited view into what those numbers actually are. And so that's why, in terms of how markets are moving based on earnings right now and very often, and I won't say that this happens every single time, because sometimes the sell side, sometimes the estimates are actually very close to what like the third party data providers are tracking to. And so if there is a beat or miss from a metric that's reported and the third party data providers are very close to consensus from sell side, and then that company reports a big beat or a big miss, then it might move exactly as you'd expect relative to those expectations. But then very often, especially this earnings season, but every earnings season, you'll see many instances where that doesn't happen. So there's like maybe a beat, like a 20% revenue beat, and the stock goes down 15%. And then you have this whole portion of people that are freaking out, questioning why that's happening. But in reality, it's because of these reasons. It's because that the people who were positioned in that business on the buy side weren't looking at the sell side estimate numbers. They were looking at some other number that you weren't seeing. And so I guess I just wanted to bring more attention to that. And I think that this is the way that alternative data is impacting markets more and more over time, and will continue to impact markets more and more over time, because as buy side uses this tool as a way to gauge where they actually think performance will be, then that is what will become the real backbone to what the actual consensus is for many of these metrics. And what I think will be interesting to see in the future is something that I'm even thinking about with ticker trends, for example, is many of these third-party data providers, they use things like Visible Alpha as a way of gauging market expectations. So as a third-party data provider, if you're Yipit or mScience, you're paying for this service called Visible Alpha, which is a service that aggregates sell-side research to gauge analyst estimates on markets. And what Visible Alpha does is they don't just give you revenue and EPS estimates, but they also give you estimates for all the other reported metrics from that company. So even KPIs or other metrics from that company. And what I almost think will happen more and more over time, and what we're even thinking about at Ticker Trends, is there's almost this thing of anticipating what other people are anticipating. So if you're a Yipit or mScience and you're becoming so saturated that every buy-side analyst is paying for a subscription to those services, and those data releases are moving the market, then now what will end up happening is the true consensus that other third-party data providers should base on is not what analyst estimates are through Visible Alpha, but instead it should be what other third-party data tracking is tracking to. So my prediction is that what will end up happening in financial markets for discretionary analysts and buy-side and sell-side firms is like this idea of consensus being derived from sell-side firm estimates will start to go away. And instead, there's going to be this battle between third-party data providers of different people giving different estimates and different tracking for the same metric, and then certain providers being better than others at tracking those specific metrics. And so this is where you'll see something like, okay, Ticker Trends is tracking a certain like DoorDash gross order volume for this number, and Yipit is tracking DoorDash gross order volume for this other number. And let's say there's a big delta between those two numbers. Now you have an opportunity where both data providers are forecasting the same metric as third-party data providers, and let's say that there's a large portion of buy-side firms that have subscriptions to both of those services. Then what will end up happening is whoever's right will start to have more power in moving that business, and it will shift over time between these different third-party data providers. But again, what's interesting is that the consensus is no longer from these sell-side firms, but it's from different third-party data providers almost competing against each other. And that's where I see a lot of this discretionary analysis and third-party alternative data heading in the future because of some of these dynamics. So anyways, that was just I guess something I've been thinking about and what I wanted to talk about, especially as we're in earnings and as people see like random moves in the market that they don't really understand why a company reacted in the way that it did on earnings. Also, if you are interested in earnings expectations, we do have a whole kind of feature set on Ticker Trends, which you can always reach out to us and I'll explain to you how we gauge market expectations and some of the scores that we put out to understand where the market is truly facing for a certain data release. I think it's really important to understand that there are a lot of market dynamics which can seem very backwards because when these third-party data releases are coming out, market expectations land significantly different than where analyst estimates are. And I think that's something really important to keep in mind. Anyways, if you're interested in Ticker Trends or social arbitrage fund, email me admin@tickertrends.io and I'll get back to you as soon as possible. Thank you for watching.